Welcome back to Commercial Real Estate Now. I'm Karly.iacono. Today we're going deep on zero cash flow investments. It's a very niche part of the net lease market that I happen to know a lot about. We're going to talk about what the structure looks like, how the debt works, the tax play, and what you need to understand before you consider one. Quick disclaimer before we start, I'm not an accountant and nothing here is tax or legal advice. I'm giving you the framework, but you need your CPA before you make any moves. So what is a zero cash flow deal? A zero, as we call them in the industry, is a property where basically all the net operating income from the tenant goes straight to debt service. The investor gets zero cash flow distributions, hence the name. And that's not a flaw in the deal. That's the entire design. These are highly leveraged assets, typically 80 to 90% loan to value, backed by long-term absolute net leases from investment grade credit tenants. We're talking BBB minus or better from S&P. This is the kind of credit that makes a lender comfortable with a high leverage because the lease itself functions somewhat like a corporate bond. And the quality of that tenancy is a crucial piece to the deal structure. Now let's talk about how the debt actually works, because this is where it gets really interesting. Typically, the loan is fully self-amortizing or very close to it. So it's sized so that the tenant's rent covers debt service exactly each period. Lease term and loan term are matched, typically 15 to 25 years at the base term. And at the end of that initial term, the loan is paid off. The tenant almost always then has extension options, so the lease continues, but the investor now owns the asset free and clear of debt. The borrower never writes a check for debt service. That's the tenant's job. And because these are absolute net leases, the tenant is also responsible for taxes, insurance, and maintenance. Every operating expense is contractually the tenant's. After acquisition, the investor's out-of-pocket obligation is effectively zero in most cases. Worth noting on the debt structure, these loans are non-recourse, assumable, and fixed rate. Non-recourse is significant, of course, because if something goes wrong, the lender's remedy is the property, not the borrower personally. And the assumable fixed rate structure is a major reason these deals are attractive to 1031 buyers who need to close fast. The financing is already in place, no new underwriting, no rate risk due to volatility. Now, there are usually assumption requirements that vary by deal, so you really want to get clear on those on the front end. But otherwise, the process is generally straightforward. Now, here's the feature most people haven't heard of. And honestly, it's why a lot of sophisticated investors specifically seek out these kinds of deals. It's called the paydown readvance. Built right into the existing loan documents is a provision that gives the borrower two subsequent rights. First, the right to pay the loan balance down up to the full amount at any point during the term. Second, immediately after doing that, the right to instruct the lender to readvance the loan back to exactly the balance it was at before the paydown. Same balance, same rate, same terms. No new loan documents and no new underwriting. The loan never actually changes. The paydown and readvance happens as a single transaction, and the debt is restored to where it was before as if it had never moved. Now, where this becomes a planning tool is in a 1031 exchange. Here's how it works in practice. Let's say an investor sells a property for $20 million, $5 million in debt, $15 million in equity. They identify a zero priced at $20 million, carrying an existing assumable loan of $18 million. To complete the exchange, they need to replace their equity and debt requirements. So at closing, they put all $15 million in equity down towards the purchase. That temporarily pays the loan down to $3 million and satisfies the exchange requirements. The next day, or within whatever timing window the loan documents allow, they exercise the readvance. The lender restores the loan to the original $18 million balance, and the investor receives $13 million in proceeds tax-free. Now, these proceeds are tax-free because the IRS treats them as loan proceeds, not as a sale or a distribution. Crucial distinction. The exchange is now done and the gain is deferred. And from that point, the loan self-amortizes on tenant rent at the same balance and terms it always had. Now, I know it's kind of confusing going through numbers just listening. So if you're in an exchange and you want a real scenario, feel free to reach out directly. Now, beyond the 1031 context, zeros generate two significant ongoing tax deductions, depreciation and interest expense. And together, they're what makes them a real income shelter. On depreciation, the IRS allows you to expense a portion of the property's value each year to account for wear and tear. We all know this. It's a paper loss, no cash changes hands, but it's a real deduction. For high-income investors, those losses can offset income from other sources. With real estate professional status, they can also potentially go against ordinary income. Now, again, your CPA needs to tell you exactly how that plays out for you in your particular situation, but the mechanics are well established. Then you layer interest deductions on top of that. In the early years of a fully amortizing loan, the majority of debt service is interest, not principal. That interest is deductible. So in the first half of the hold, you've got both depreciation and a substantial interest deduction running simultaneously on a property that's building equity through tenant rent. For the right investor, that's a genuinely powerful position to be in. Now let's take a minute and talk about the risks, because you need to go in with your eyes open. The primary risk is phantom income. Under Section 467 of the Internal Revenue Code, which governs how rental income is recognized in these structured lease arrangements, the IRS accrues rental income on a leveled basis across the lease term. In the early years, your depreciation and interest deductions more than offset the accrued income. But as the loan matures, typically around years 10 to 15 of your hold, the interest deduction declines and more of your payment goes to principal. At some point, the deductions don't fully cover the income being accrued, and you start owing taxes on money you never received. This is called phantom income. It's real, it's taxable, and you really need to plan for it. Either you can have other passive deductions to absorb it, or you 1031 exit before you reach that window. The second risk I want to touch on is somewhat of illiquidity. These are specialized assets with a narrow buyer pool and a structured loan that doesn't lend itself to an easy midterm sale. Go in knowing your hold period and plan your exit before you close. Finally, let's take a minute and talk about who actually buys these. It's a very specific profile. The most common is a 1031 buyer coming out of a high equity sale looking to pull out proceeds tax-free, or a 1031 buyer looking to replace highly leveraged debt. Now, they also work great for investors with large passive income portfolios who need offsetting losses. And my favorite, estate planning situations where the goal is free and clear assets for the next generation over a long hold period. If you need monthly distributions from your real estate, this is not the right vehicle. Now, again, that's not a criticism of the deal. It just serves a very different objective. One thing worth knowing, zeros are a specialized, nuanced corner of the net lease market. They're not complicated to find, but they do require an advisor who actually understands the structure, the loan assumption requirements, and the readvance features. This isn't a product you want to learn on the fly. We have inventory. If you're in a 1031 exchange and you're solving a challenging scenario where you want to just run the numbers on whether a zero fits your individual situation, reach out. Contact information is in the show notes. The bottom line on a zero, it's not a deal that underperforms, it just performs differently. The return builds in equity, tax deferrals, and deductions, not in monthly distributions. For the right investor, it's one of the most efficient structures in the market. I'm Karly.iacono. This is Commercial Real Estate Now, and we will see you again next week. Take care, everyone.